In this month's market update, we're going to talk about tariffs. Steel and aluminum are already in effect, and we may see more at the end of April.
We've also got the latest numbers from the National Association of Realtors.
And finally, we'll tie it all together with mortgage rates. Where are they now? Where are they going? And what does it mean for us?
All that and more in this month's market update.
I'm here with special guest host this month, Jay Papazan. We're going to talk about tariffs.
Hey, I'm excited to be here. I love talking about this stuff.
So, Jay, what's a simple definition of a tariff?
A tariff is effectively, it's kind of like a national sales tax, the way it works out. So you impose a tariff on a foreign exporter. It's actually paid by whoever's importing the goods. So in this case, a U.S. importer of like steel or aluminum is the one that pays the tax to the U.S. government. But do they actually pay that tax effectively?
Historically, we see it pass on to consumers. Typically, historically speaking, when we'd see a tariff, it would be on a specific category of good. And right now, that's where we're at with steel and aluminum. It's a little bit weird because it's not just raw steel and aluminum. They're actually including anything that's mostly made of steel and aluminum. So your patio furniture prices may have gone up recently. But come April, we may be looking at a little bit of a broader tariff. This is something a little bit unusual. Historically speaking, we don't see blanket tariffs against countries other than in the form of almost absolute embargoes. So, seeing a 25% tariff across the board for Mexico and Canada is going to be a little bit of an experiment in terms of economic policy, historically speaking. And we know that we get lumber, we get gypsum, and a lot of other products from both those countries that are involved in home building.
Yeah, those are primary components of a lot of the homes, and a lot of the things, like we think about oil coming from Canada as well. So anything that you have to move around the country, if it relies on any foreign oil in that case, is going to be more expensive. And then just like the wild card to me is all of the little components that are made kind of locally, either in Mexico or Canada, that are just parts of something larger that might be included in that as well.
Yeah.
So who knows how that shakes out?
Yeah, I mean, it's going to affect things like appliances, things like cabinetry, flooring. There's so many pieces of a new home construction that are going to be touched by this. And it's really, we don't know, right? We don't know exactly what's going to happen. We are fairly confident it's not going to lower prices. To what extent they go up, we'll have to see what happens.
I think in the short run, you might not see a direct impact because people are going to make adjustments, or it might, like in the case that happened a couple of times, it was imposed and then taken back and delayed. So, but if it stays in effect long enough, at some point, these companies will be passing it along. That should, drive up the cost of homes, especially new homes and new construction. At a time with higher mortgage rates, that means it's just going to be higher cost. It's inflationary at the end of the day if it plays out that long.
Exactly. And on the builder side, we may not see it for a while. One of the things we've seen recently is builders actually hoarding materials.
Oh, yeah. We saw that after COVID, right, when there was artificial shortages. If you had supplies, let's just say gypsum, right, which we know might be impacted. Man, I need a lot of drywall because I'm going to build a lot of homes. Can I just go ahead and buy all of it up front, which they almost would never do before? And then I'm just going to keep it in a warehouse in case it goes up. Now that creates a shortage of supply, and what happens to prices for everybody else?
Right. They're already starting to go up ahead of the tariff potentially.
Yeah. How does that impact existing home sales?
We have something called a substitute good, right? So in theory, a new home is a substitute good for an existing home. When the price of one of those goes up, if you go back to your textbook, it pushes up the price of the other one. In our case, what that means is, some demand, essentially, buyers will shift like, well, if my new home's this much more expensive, I may have to confine myself to existing homes, meaning the pool of people now shopping for an existing home versus a new home, like the demand shifts in, drives the prices up for what we already have in some places very limited inventory of in terms of existing homes.
Does that favor existing home sellers, or does that create more pressure and drive up prices? Like, how does that play out? It seems like it favors existing home sellers of existing homes.
It's basically going to put more upward pressure on prices, potentially negatively affecting affordability across the board, not just for new homes. And yeah, it advantages sellers a little bit more, right? Because anytime you've got more demand for existing homes, it puts the seller in a slightly better position in terms of the negotiations. So let's talk about home sales now. We have the NAR numbers. What were existing home sales? Like, what's the first stat we got here?
Right. So month over month in February, they were up 4.2%, right? Which I've seen a lot of headlines, home sales up 4.2%, like, because people are looking for a bright spot anywhere right now. But if you look at it year over year, right, we're still down 1.2%. So is it good news or bad news, Ruben?
It's both, right? So the trend is in the right direction.
Yeah.
But we are lagging a little bit behind last year. We were down this month from last year. Last month we were up a little bit from last year. Year to date, if you kind of combine the two, we're a little bit behind last year. Where we're going to make up that ground in sales potentially is the summer month. The summer months were pretty abysmal last year. We were posting below 4 million homes per month. This year, the hope is that we're going to see rates more stable. I don't think we're going to see super low rates, but we'll be in the mid sixes, probably bouncing around there as we head into that time of year. That's going to put rates year over year probably down. So that's good for home sales. Typically, if you look historically at the figures, when we've had a downturn in home sales, when do they start bumping back up on a year over year basis? Usually one of the key indicators for that is that mortgage rates are down below where they were the previous year.
The difference between 5% or 7%, it does mean a lot. But for people who are in the market to buy homes, their urgency to get in the market can be like really cooled off when rates are going up. And when rates are going down, even though the absolute number may not be the perfect number, they just see that creates positive momentum.
Essentially, as we head into the summer, we should be seeing better home sales than we saw last year. That's how you'll know. If you're wondering, are we going to be better or worse than last year? If you look up in July and August and we're doing better, we're going to outperform. If we're doing worse than last year, like home sales are potentially going to be flat or even worse than last year. That'll be the telling months.
We've got a few months to tell. It'll be interesting to see our typical seasonality come back. Like January and February are never the biggest months of the year in our industry, unless you have like a really weird set of circumstances like we had around the backside of COVID. Well, it also means inventory. So inventory numbers are up to 1.2 million homes. What does that mean? So we have 3.5 months of supply. So it's actually up 17% year over year. I personally think that's good. What do you think about it?
Yeah, it's trending in the right direction. It's going to move us a little bit into more buyer's market territory, which we haven't been in quite a while.
Right.
But at 3.5 months,
it's still relatively low supply.
Exactly.
Right.
So the thing we really have to watch there is what's the impact on prices, right? Because there's this push-pull between supply and demand. We know demand's fairly low, supply is going up. Prices are still going up. Last month we saw 3.8%. That's, we like to say 4% is sort of the long-term normal home appreciation rate. So we're kind of right there right now. For the year, that's also kind of where we're projected to fall, somewhere in the 3 to 4% range. Is it the ideal situation? I think it depends on who you are, right? If you're a seller, obviously you'd like to see that go up more. If you're a buyer, you'd like to see it go the other direction.
A lot of sellers are also buyers. That's the irony.
Yeah.
They're selling their home in order to buy another one. And if they're moving up, like it matters even more. We're trending in the right direction. I think the market will be healthier for both buyers and sellers if we get to higher inventory levels.
The last thing, on our list of things to talk about today is what's going on with mortgage rates. Good news right now, we've been kind of on a downward trend. It's stabilized a little bit around like 6.75, 6.8 recently. But we're coming off of like what was an increase, right? We had gotten all the way up to about 7. So the good news is that downward trend is going to translate into some buyers getting off the fence probably coming into the spring. That's where we're at right now.
What is the Fed signaling right now?
The Fed probably is only going to lower rates like one time this year based off of, their own projections. And kind of the market's projections of what they're going to do. That will probably come sometime toward the end of the year. That's not to say that mortgage rates won't move around in the meantime.
The Fed does not directly impact mortgage rates. Like we should be really looking at bonds for that, right?
Exactly. So the 10-year Treasury is going to move around on its own. There's a lot of other things that drive that. We've actually seen some of the uncertainty around things like tariffs and other things push money into bonds because bonds are safe, right? So that's actually part of what's trended mortgage rates down is this idea of this fear of an impending recession, this idea that tariffs are going to hurt businesses and things like that. So moving money from riskier assets into the safety of a 10-year Treasury has driven down that rate. And it's part of what's contributed to mortgage rates coming down recently. So that's sort of the caveat of like rates are coming down, but they're not necessarily coming down for good reasons. Because if the fears that are driving them down kind of come to fruition, then we have to worry about things like rising unemployment and how that plays into our market as well. As things currently stand, the projection is still to hopefully get down around 6.5%, maybe a little bit lower by the end of the year, depending on how the rest of the economy plays out. If I was a betting man right now, I might take the over on that. But we'll see kind of like where this balances out in terms of the money moving around with treasuries versus the equities markets and things like that.
We saw a little bump earlier this year. When you drop below 7, there's something about that number that seemed to be significant. It's just because when it started trending down, even though it's still relatively high compared to recent years, it didn't seem to make a measurable impact in demand. Yeah. So if we can stay in the range of the mid to high 6s, it's less bad than it was last year.
Yeah, and we hinted at this, or we talked about it a little bit earlier, in that when rates go down year over year, that seems to have a psychological effect and kind of stir people back into the market.
Yeah. Final word?
Final word. As of right now, the economy is still strong. We'll have to see how it plays out across the year. The housing market, we're a little bit behind where we were last year, but it's still looking like we're going to...
early.
Yeah, it's early. We're going to do all right. Prices are growing, but not astronomically, though the Northeast has a more challenging situation. And buyers are going to have more choices. That's sort of the big positive here, is that if you are in the market, you have options. There's going to be more houses available. You're going to have more ability to negotiate for the first time in quite a long time. So as a buyer who, has the financing right now to be in the market, it's a good time potentially. As for a first-time buyer, it's a little more challenging. For a move-up buyer, there's opportunity, right? But it's just, you have to really do your math and understand where you're at.
Well, thanks for having me this month.
Yeah, it was great having you on, Jay. Thank you for joining us on this month's Keller Williams Real Estate Market Update. Thank you, Jay, for being on the podcast with me this month.
I loved it. It's always fun to talk the numbers with you. And just a reminder, if you've loved what you heard on this video, there's a longer form wherever you listen to podcasts. Go to Spotify, Apple, or whatever your favorite podcast platform is, and look for the market update.